90% of traders struggle to identify valid order block. When the market forms multiple order blocks, traders often get confused about the right entry point. As a result, they end up losing all their money. So, in this video, I'm going to reveal 5 secret strategies to identify a valid order block. And that's not all. I'll also explain the hidden psychology and strategies used by institutions. Using this psychology, you'll uncover the secret reason why the market respects extreme order blocks and how to predict which one it will respect. Plus, I'll reveal an advanced Smc Ict indicator that can identify pullbacks, market structure, order blocks, fair value gap, liquidity, and 50-plus powerful features, all with 100% accuracy. Let's understand what is order block. Here we have 2 definitions, general definition and institution secret definition. So first understand the general definition of a bullish order block. When the market is bullish, the last bearish candle before a bullish move is known as a bullish order block. Here, in this bullish move, this is the last bearish candle. So this candle is known as order block. When the market mitigates this order block, it can show a significant potential move. Now let's explore what is bearish order block. When the market is bearish, the last bullish candle is known as the bearish order block. Here, in this bearish move, this is the last bullish candle, so this candle is known as an order block. Now let's uncover the institution's secret definition. Here, the market is bullish after boss. Whenever market is bullish, institute buy after liquidity sweep or FVG mitigation. So the question is, where is liquidity? Here we have liquidity in swing low. But institutions can't take entry like retailers at a fixed price. Let's assume institution are interested to buy 10 lakhs quantity at 9 rupees. When they buy, prices will be directly bullish, and most of their quantity executes at different prices. 50% quantity at 9 rupees, 30% quantity at 15 rupees, and 20% quantity at 20 rupees. But here interesting thing is, institution buys at 9 rupees, and their final order is placed at 20 rupees. As a result, they suffer a huge loss. Therefore, institution execute their big order in the zone. Here, the institution is buying 10 lakh shares within a specific price zone, so most of their quantity gets executed at the current price. However, 3 lakh shares remain unfilled due to the large order size. This drives the institution back to this zone, presenting a golden opportunity for a retail trader to align with their moves and achieve substantial profits. So the institution pending order is known as a demand zone or order block. So, finally, I'm going to reveal 5 secret strategies to identify a valid order block. This level of content is not available in any YouTube videos or expensive paid courses. Before we proceed, let me introduce an Smc Ict price action advance indicator. It has 50-plus powerful features. Like, this indicator can draw true SMC market structure with 100% accuracy. It can also mark ICT fractal market structure. Most importantly, this indicator can mark order blocks, breaker blocks, mitigation blocks, and demand and supply zones. This indicator can mark both minor and major pullbacks with 100% accuracy. It can also mark bearish scoob and bullish scoob. Using this indicator, you can mark multi-time frame order blocks. It can draw fair value gaps, liquidity, support, resistance, breakouts, and more. If we look at recent gold example market exactly bullish from indicator order block and blue scoob. This indicator has 50-plus powerful features. If you want to trade like an institution, you can message me to purchase this indicator on Telegram. If you purchase today, you will also get 5 SMC and ICT free PDF courses. All right, let's start with 5 secret strategies to identify valid pullbacks. The first strategy is that the order block should sweep liquidity. Here we have two order blocks, and you need to identify which one is valid. The correct order block is the one on the right. If we analyze the left order block, the last bearish candle is an inside bar candle, and it doesn't take the liquidity of its previous candle, making it an invalid order block. On the other hand, the right order block is valid because the last bearish candle sweeps the liquidity of its previous candle. Remember, if order blocks sweep more liquidity, then order block will be more strong. Here, the market forms two types of order blocks. The question is, which one is stronger? The answer is second order block, because if an order block is formed after a strong liquidity sweep, then very high probability is the market showing real impulsive moves without trapping further. Now the second strategy is order block with FVG or imbalance. First, let's understand what is FVG. FVG is the gap between the first and third candles. Here we have two order blocks. You have to identify which order is valid. The valid order block is the first one, because it had a fair value gap between first and third candles. Now, let's dive into the third strategy. The order block must break the recent swing. Here, in this bullish movement, the market not only breaks the recent swing, but also sweep the low last bearish candle liquidity, making this order block more powerful, and market mostly respect this types of order block. Now the fourth strategy is order block should be unmitigated. This order block sweeps liquidity, and it has a fair value gap, and also it is unmitigated, which makes this order block more powerful. Here, second order block don't have FVG, and this order block is already mitigated, so it is invalid. Usually markets sweep liquidity of this types of order block to fuel their buy position. Now the fifth strategy is liquidity should be above the order block. Here, in this bullish move, market makes liquidity just above the order block. So buying from this order block is a high probability trade, as it has a strong likelihood of being respected. But here, in this bullish move market, don't make a liquidity, so buying from this type of order block is very risky. Remember, when there is no liquidity, then a valid order block will act as liquidity, and market mostly bullish after taking their liquidity. Now, let's break down some examples. The market is bullish following a break in structure, which also creates an inducement, and here we have two order blocks. Now the question is, from which order block we should take entry, either the first or second one. Now, let's apply all the rules which we have previously understood. The first rule is order block should sweep liquidity. Here, first order block close below the previous red candle, so it invalid. However, in the second case, it sweeps the previous red candle, making buying from the second order block valid. The second rule is that an order block must have an FVG. Here, the FVG of the first order block has already been mitigated, but the second order block has a clear, unmitigated FVG, making it much more powerful. The next strategy is that the order block should be unmitigated. Here, the extreme order block remains unmitigated, while the first order block was already mitigated by the next candle. This makes buying from the second order block a high probability trade. Now, the most powerful strategy is order block should be in unmitigated order flow, otherwise order block will act as liquidity. Here in this case, extreme order flow is unmitigated, so buying from its order block is very probability zone, and market mostly respect this types of order block and give very powerful move. That's it for today's video on order blocks. Make sure to practice what you've learned, and don't forget to like, subscribe, and turn on notifications for more powerful videos. See you in the next one.